One more time, I'm sorry. Good afternoon, welcome to the presentation of the new indicator. MarketTimers Price Navigator Pro. It is a navigation tool for price movement for all types of traders and investors. Whether you trade with locals, build an investment portfolio, or play with futures, it works in all time frames, and every investor or trader who uses TradingView should have it turned on there. This indicator is only for invitations, so first you have to make sure that I invite you to this indicator on TradingView. I invite every investor to MarketTimers.com, so you can register there, get a membership, and then you get access to this indicator. By the end of March, it will be available for all tiers. When you are registered, you can find this indicator. You will find it in the indicators invite only, and then it will be displayed here. Then you can copy it to all layouts. You can do this with one of the 3 T's. Add this indicator to entire layout. Those who have the cheapest version of TradingView have only 2 windows. I have a higher version, so I can easily add 3. I always monitor the market from 3 time frames at once, so that I can take all the steps in context. So when I work with my investment portfolio, I monitor the daily, weekly, and monthly graphs. At the same time, the indicator shows me what the indicator is doing at that specific time frame. The Price Navigator shows why we need navigation. When you drive a tractor, a truck, a car, a plane, a ship, you always need navigation. The same is true for capital markets where the price moves in some way. The price movement has some statistical properties. Within these statistical properties, you can navigate your probability. That is where and how the price will probably move. Probability does not mean certainty. However, if you own a casino and run a roulette, you have a certain probability that a 0 will fall and the casino will win. So the 0 in the whole game adds your probability. And if you play enough games in a row, you will win. The Price Navigator, along with other tools, allows you to operate on the market as a casino. That is to take your steps within the probability that money will come to you. That is why we need the Price Navigator, so that we can interact repeatedly with the market in places where probabilities play for you. So that you behave not as a gambler, but as a casino. What do we see on the indicator? The first thing is the probability price range. The price range shows us where the price will oscillate. Most of the time, the price does not move in a straight line. The price movement is a stochastic process. It is like driving on a sand dune. The sand runs left and right, but basically moves forward with you. This shows you the probability range. Where is the price suitable for buying? Statistically, it does not mean that this is a witch or a crystal ball that knows that the price will turn up here. No, you never have 100% certainty. It's about probabilities. And if you make decisions based on the probability that are historically proven and backtested, you will be the casino that makes money. This probability range has a model that differs mathematically. That is, according to a repeatable, clear calculation, if the market moves sideways at a specific time frame, that is, if it consolidates, or if there is a trend in the market. If it is gray at the back, then the market consolidates. This means that the model is used to calculate the ranges that use the statistical property of the price movement of the trending market. If the market is trending, another model is used. These ranges adapt to the trend and show where the price will go or where it will move in the trend. Because the movement is different. If we are in consolidation, we know that the price oscillates between one and the other extreme. And the biggest probability on the downside of consolidation is that the price will turn backwards. That is, when there is a breakout, a trend, we can expect a trend channel to form. So these are the ranges. If they are green, that means they are trending. And these ranges have momentum. That means that the top of range shows higher highs, higher highs, higher highs. The low of range shows higher lows, higher lows, higher lows. And that means it's green. If we go to the indicator settings, we can set the parameters of the price ranges at the beginning. Here we set the lookback period. This is a universal lookback period for all 16 time frames. It is something that generally works well on all time frames. If you want to set a lower number on higher time frames, it's up to you. You have to test it yourself, or at least visually see how it works for you historically. In general, I use 8, 16, 32 of these timescales. I come out of one white paper that shows that these timescales give quite similar results in the tests. So here you set the lookback period of the ranges, then the lookback period of the consolidation index. This means that if you want to have a wider context of consolidation and you want it to react slowly, you increase it. If you want it to show you some micro consolidation and especially to make it jump faster, you can reduce it. Is in the consolidation index, which counts whether we are in consolidation or not. This is the number. If you think it will start to be gray too soon, you can increase it to 55, for example. Here you can set the colors of the edges, the colors of higher high and lower low. This is the color of the consolidation index. Here you can set the transparency of the background. And then another thing we will talk about, this is the second essential thing that the navigator shows us, are the trend links. These trend links are exponential closed averages. In fact, every algo, every modern CTA, very few people use ordinary closed averages anymore. They use exponential closed averages. Its advantage is that it adds more weight to the freshest data. So if we have it set here that we want to see 32 days, for example, a closed exponential closed average, here it is set to 32. It still has the greatest weight in the last 8 days. So it reacts faster and the values move more. Another advantage is that we have it set to 32 here, but if you had it set to 27, or even just 22 or 20 or 50, plus or minus, and we see something similar, and the difference between us and someone who has it set, the period of retrospective who has it set differently. It can happen that you start to be bullish, I don't know, in 3 days or 2 days earlier or 2 days later than someone else. But basically, if the trend starts, you will all be bullish. You will all see the same thing, whether you have it set this way or that way. So this is the advantage of exponential closed averages. Another thing I came up with for retail investors and traders is intelligibility. That means instead of doing, I don't know, 20 days, 200 days, 1000 days and closed averages, I divided it into the fact that we always look at closed averages in a specific humanly understandable time frame. So for example, here we see on the label marked 1D, that's a daily closed average. So it shows us a 32-day exponential closed average. That's the green line. At the same time, in one window, we are here on the daily graph. But at the same time, that's the beauty of this indicator. It shows us a weekly closed average as well. So here it is, 1-2 TV, that's in English 1 week. So that's a 32-week exponential closed average. And we can see it here. You can see how it's going fast, that it always takes 5 days for the trader to move on to the next week. So we see a 32-week exponential closed average. 1 week has 5 days in it. So the week is times 5, it's daily times 5, so it contains 32 times 5 days. That's about 160 days of the closed average. And it's getting closer to the 200-day closed average. And then there's the monthly one. This one shows a 32-month exponential closed average. You see 1M. Then there's the quarterly one, that's Q1Q. Then there's the semi-annual one, that's SA. And then there's the long-term one, maybe we'll have it on spiders. Then there's the annual one, that's 32 years. That's really a lot. This script separates intradaily timeframes from daily ones. It doesn't show us the intradaily timeframes or the trend links or what I call the trend link. It's just the exponential moving average. On the TradingView, the intradaily timeframes show something strange. So, for example, if you have an hour-long link on spiders, which is basically 8 hours, it's hard to show you 8 points here. So you have to click at least into the 4-hour time frame or into the hour-long time frame to see the intradaily links. We have a 4-hour link at our disposal. That's 4H, that's 32 4-hour segments. Then there's the hour-long link, the orange one. Then there's the 30-minute link. If we go even lower, for example, to the 15-minute time frame, we'll see the lowest trend links from the lowest time frames. We'll wait a bit for it to jump. Here we can even see the 5-minute one and even the 1-minute one. So it's quite important for intradaily traders to identify intradaily reversals and so on. So that's what we can see. We can see the price distribution, the probability of where the price will move. We can see whether the market is trending or consolidating at a specific time frame. And then from a large number of time frames, we can see the trend links, which is nothing more than exponential circular averages. And we can set their length here in the settings. I've set it here as a default setting, what I use. The label setting, label offset from last bar, how far you want the labels to be from the last bar. What I've just shown you was in the automatic display mode. It automatically shows me the relevant trend links from the relevant time frames. But if you want to choose by yourself, you can switch to the menu mode. You can see that nothing is showing here. So now I've turned on the clock and now I can see the time frame. So you can switch between automatic mode and you can set the length of the links. So this is the settings. Now we could talk a little bit about what the trend links are showing us. You always have to choose. Even if you have my indicator, even if you don't listen to me all the time, when you shop or invest, you have to tell yourself, what is my basic base? Where are my basic trends? What is my basic time frame? So when I make my investment portfolio or when I look at longer swing trades, for me the basic time frame is a week. So I look at the weekly graph. And when I look at the weekly graph, I also look at another faster time frame, which is a day, and one slower time frame, which is a month. So I choose the basic time frame, then I look at the faster one and the slower one, and then I make a decision. There are several basic methods for making a trend following. One of the methods is to just look if the price is higher than it was a month ago. These are the most basic ones. But I like the method where you use a close average from a faster time frame and a slower time frame. And always when the close average is faster than the slow one, I want to be long, and when it's short, I don't want to be short at all, or I want to be short. We want the daily flow to be long and the daily price to be fast. The fast flow is above the slow flow. If I want to trade intraday, and I say that my main flow will be the hourly flow, I will switch to futures. Here we have the hourly flow, and I want to follow the basic slow flow. And as a fast flow, I want to follow the 5-minute flow. You can see that I'm missing 15 minutes for intraday trading. I will follow the 5-minute flow, and as a slow time frame, I will follow the 4-hour flow. I recommend to set the scale price chart only, so that the prices don't go up too much because of the indicator. We have already discussed this on Discord, so if I have a 5-minute flow above the hour, I want to be long. If I have a 5-minute flow below the hour, I want to be short. But at the same time, I want the hour to be below the 4-hour flow. So what I'm showing you, I can do on intraday trading, or I can say that my main time frame is monthly, so I want to make long-term investments. My slow time frame is 3 months and 1 bar is 1 quarter. Let's put SPX here. There is a lot of data. This means that I want to make long-term investments from the monthly line. This is the monthly line. So what do I want to see? I want to see that the weekly line is over monthly and the monthly line is over quarterly. I want to buy when the market is on the low of range on the quarterly time frame. And then when we are on the top of range, I just hold or choose the time of profit. It depends on how you do risk management. Here on the monthly line, for example, we can see the gray color from October 2022 to September 2023. From this time frame, it was some kind of consolidation. First, there was a breakout and then there was a recess. So here you do execution for a long time when you want to look at it only once a month. For me, this is too long a time frame. My longest basic time frame is a week, which means a fast time frame is a day, and a slow time frame is a month. That's what I personally use. So for me, it's a very simple rule how I recognize a trend. I recognize a trend in such a way that the daily line must be over a week, the green line must be over this purple one, and the weekly line must be over monthly. When the daily line is over a week, it's a signal for me to leave the market. So here we had a signal in 2022, at the beginning of 2022. And we started to be bullish again in 2023. But here we had a consolidation, as you can see. So we were waiting for a breakout, which came, and then there was a recess. I didn't do business at the time. I wasn't in a state to do business. Nevertheless, in 2024, the best opportunity was a recess. And in August, retesting of the daily line for entry into the Bank of Japan was absolutely not a foundation to break the American market. So it was a great opportunity to buy on a break as part of the unbroken trend. So these trend links show you whether the market is trending up or not. If we look at TLT, we will see here in 2023, there was a huge, in 2024, at the beginning of 2024, there was a huge mania to cut to infinity, to go back to zero. And the bonds will fly into space. But if we look, the momentum of the monthly line is strongly negative. The momentum of the quarterly line goes down. If you look at SP, the momentum is positive. All those lines go up. But if we look at TLT, the bonds go down. Yes, we had a few months of bear market rally in bonds. By the way, we entered the market timer. these entries into the bear market rally with the help of a lower time frame, a faster one. At the moment when the daily line crossed the weekly line, then we had a red test, and here we jumped, and after about a month, we left the trade with a profit. Now again, there is a threat of a breakout. Here we have an inverse head and shoulders. At the monthly time frame, we are actually in a consolidation. You can see a gray color here. That means that at a high time frame, the market is consolidating. Everyone can see that the market is consolidating. So in consolidations, the most likely scenario is not a downward trend and a crash, but a turn back to the middle. The weekly line is somewhere in the middle. Then there is the half-yearly line. So again, we can go to a lower time frame. I'm waiting for the moment when the weekly line crosses the daily line, and then I will look for a hedging or a short-term upward trend. For a long time, I traded with SASB through MTBA. Compared to TLT, they were in a bull trend. The green line was above the weekly line, and here I jumped during the red test of the weekly line. I'm still in that position. And here I will choose the first profits for the half-yearly line. The daily line is still above the weekly line. It's still holding, so I'm still in position. That's why I didn't trade with TLT, but with MTBA. That's all for this presentation. In the next webinar, we will show you how you can build a strategy directly from scratch.